Hey everyone, it's Thimao, and let's be real, nobody likes the word debt. It feels heavy, like a burden holding you back from the things you want in life. But here's the thing, debt is a tool. Just like any tool, it can be used recklessly and get you into trouble, or it can be used strategically to build wealth. The US economy itself is built on debt. In this video, we're diving deep into 5 ways rich people leverage debt to make money, grow their wealth, and create financial freedom. We're going to break down these strategies so you can understand the mechanics behind them. See how you might be able to apply some of these principles to your own financial journey. Let's kick things off with a strategy that's incredibly common in the business world. Trade and product financing. Imagine you're an entrepreneur wanting to sell high-quality pens. You need inventory, but buying it all up front ties up a significant chunk of your capital. This is where trade financing comes in. Instead of paying for the entire inventory up front, you can establish a relationship with a supplier. Once you've proven yourself reliable, the supplier might be willing to loan you the pens. You get to sell the pens, collect the revenue, and then pay back the supplier, keeping the profit you made. This strategy is all about leveraging other people's money, in this case, the suppliers, to fuel your own business growth. It frees up your capital to reinvest in other areas of your business, like marketing or expanding your product line. You need to be confident in your ability to move those pens, manage inventory effectively, and generate enough revenue to cover the supplier's costs and your profit margin. Trade and product financing is a powerful tool for businesses of all sizes, but it requires careful planning and execution. By establishing strong relationships with suppliers, managing inventory efficiently, and becoming a sales pro, you can leverage this form of debt to fuel your business growth without depleting your own capital. Think about clothing boutiques, electronics retailers, even food vendors. They all rely on some form of trade financing to keep their shelves stocked and their businesses running smoothly. So if you're looking to start or grow a business, don't shy away from exploring trade financing options. Now let's talk about a strategy that's near and dear to my heart: real estate. Specifically, real estate refinancing. This is a favorite among wealthy individuals, and for good reason. It allows you to tap into the equity you've built in your property and use it to fuel further investments. Here's how it works. Let's say you purchase a property for $500,000. You put down a 20% down payment, which is $100,000, and take out a mortgage for the remaining $400,000. Now you decide to renovate the property, adding value and increasing its market appeal. After the renovations, the property appraises for $700,000. You can refinance your mortgage based on the new appraised value of $700,000. This means you can potentially pay off your original $400,000 mortgage and even pull out some of the equity you've built. You've essentially used debt to increase the value of your asset and free up capital for other investments. Remember, mortgage interest is often tax deductible, which can lead to significant savings come tax season. Plus, if you're renting out the property, the rental income can help cover your mortgage payments, potentially creating a passive income stream. Of course, real estate refinancing isn't without its risks. But when done strategically, real estate refinancing can be a powerful tool for building wealth, generating passive income, and leveraging debt to your advantage. Now, let's step into the world of high finance and explore a strategy that's often shrouded in mystery: hedge funds and shorting stocks. Hedge funds are investment funds designed for wealthy individuals and institutions, and they often use complex strategies to generate returns, including shorting stocks. Shorting stocks, also known as short selling, is essentially betting against a company's success. It involves borrowing shares of a stock you believe will go down in price, selling those borrowed shares at the current market price, and then repurchasing them later at a lower price to return to the lender. Let's say a hedge fund believes that company XYZ's stock, currently trading at $100 per share, is overvalued and will soon decline. They borrow 1,000 shares of company XYZ from a broker and immediately sell them on the open market for $100,000. Now, imagine their prediction comes true, and company XYZ's stock price drops to $50 per share. The hedge fund repurchases 1,000 shares for $50,000 and returns the shares to the broker they borrowed from. The hedge fund's profit is the difference between the selling price and the repurchasing price minus any fees or interest charged for borrowing the shares. Shorting stocks can be incredibly lucrative, especially in volatile markets or when a company faces significant challenges. However, it's also incredibly risky. If the stock price goes up instead of down, the hedge fund could face unlimited losses as they're obligated to repurchase the shares at whatever price they're trading at. This strategy is not for the faint of heart and requires a deep understanding of financial markets, risk management, and the ability to accurately predict market movements. While shorting stocks is not a strategy for individual investors with limited capital, it highlights how hedge funds and wealthy individuals use debt to capitalize on market downturns. Now let's dive into the fast-paced world of Forex trading, where leverage can be a double-edged sword. Forex, short for foreign exchange, is the global marketplace where currencies are traded. It's the largest and most liquid financial market in the world, with trillions of dollars changing hands every day. One of the key features of Forex trading is leverage, which allows traders to control larger positions with a smaller amount of capital. For example, with a leverage ratio of 100-to-1, for every $1,000 you deposit into your trading account, you can control $100,000 worth of currency. This amplified buying power can significantly magnify your profits if you predict currency movements correctly. Let's say you believe the euro will strengthen against the US dollar. You use leverage to buy euros with US dollars. If your prediction is correct and the euro appreciates in value, your profits are multiplied by the leverage you used. However, leverage is a double-edged sword. While it can amplify your gains, it can also magnify your losses. If the market moves against your prediction, your losses are also multiplied by the leverage used. This is why Forex trading is considered high risk and requires a deep understanding of market dynamics, risk management, and trading strategies. While Forex trading can be an exciting and potentially lucrative endeavor, it's crucial to approach it with caution, especially when using leverage. Now let's shift gears and talk about something that might seem less glamorous than hedge funds and Forex trading, but is equally important: building a strong credit score. While it might not sound as exciting as leveraging debt for high-stakes investments, a good credit score is the foundation of financial freedom. Wealthy individuals understand the power of a good credit score. It's not just about qualifying for loans, it's about securing the best possible interest rates and loan terms. A high credit score can save you thousands, even hundreds of thousands of dollars over your lifetime in interest payments. Think about it this way: a lower interest rate on a mortgage, car loan, or even a business loan means you're paying less in interest and more towards the principal, allowing you to build equity faster and save money in the long run. It's like getting a discount on your debt. But how do wealthy individuals build and maintain excellent credit scores? It's not magic. It's about consistency and responsible financial habits. They pay their bills on time, every time, whether it's their credit card bills, utilities, or mortgage payments. They also keep their credit utilization low, meaning they don't max out their credit cards. A good rule of thumb is to keep your credit utilization below 30%. Wealthy individuals also understand the importance of having a diverse credit mix. This means having different types of credit accounts, such as credit cards, installment loans, and potentially even a line of credit. Building a strong credit score takes time and effort, but it's one of the most valuable financial assets you can have. So, there you have it. 5 ways wealthy people use debt to their advantage. As we've seen, debt can be a powerful tool for building wealth when used strategically. It's not about avoiding debt altogether, it's about understanding the different types of debt, managing it responsibly, and leveraging it to create opportunities. Remember, high-interest debt like credit card balances can quickly spiral out of control and sabotage your financial goals. Focus on paying down high-interest debt as quickly as possible and avoid accumulating unnecessary debt. Instead, focus on building good debt that helps you build assets, generate income, or grow your business. Whether it's leveraging trade financing to start your business, refinancing your property to free up capital, or even using debt strategically in investments, remember that debt can be a tool for wealth creation when used